Happy Thanksgiving week. Jonathan Camarda, your humble CIO. Hopefully you guys are all doing well. Been a few weeks since we spoke, so the Fed went 75 basis points as we thought, but the market has been pretty resilient. Earnings have not been that bad, relatively speaking. Of course, it's been binary. You've seen some companies flunk the test and others which are scoring pretty nicely. What we've seen is the dollar and interest rates actually dropped the last few weeks, although within the overall trend, they're still in an uptrend, so I wouldn't guarantee that this is going to continue. In fact, I wouldn't expect it. However, that's pretty good news on the macro front, and that's what's given some breath of life into technology stocks, which you've seen, which have a decent little run as rates go down, right? We've talked before the calculus on that. Although the best performing sectors the last few weeks are still utilities and consumer staples, so that again usually portends of a defensive market. And we do stress the market is still in an overall downtrend. You just have an air pocket to the upside during a seasonally strong time of year, post-November to the end of the year, and certainly post-election as well. So all that's following suit. Now you'll see in some of your strategies that we have taken a little bit more, risk-on positions in, opportunistic growth and income, increase the dividend stock exposure there a little bit, and your sector momentum as well. I've had more, sector selection to the upside there, and then your more aggressive equity strategies like Global Macro and Velocity Raptor, which have again been surgically moving in and out of attractive stocks within higher performing sectors when you start to look at what they call quantitative heat maps, not getting too deep, especially before the holiday. And of course, Bull Bear, which is a part of some of your strategies as well, has been the anchor of risk off, holding that that Federal Reserve Overnight Repurchase Agreement Fund, aforementioned as SNOX, Fort Knox. What an unfortunate name, but a pretty yield, especially with money markets still earning close to nothing. So you may see that in your strategy as well, and the such there. So where do we see things? Again, we called recession back last June, and of course we've had re-rolling recession, so we were right. And now the umbrella of recession, you're starting to see the tea leaves and really see them, aren't you? If you look at home prices, across the country. Of course, Florida's been pretty resilient because of the economic, nomadic shift from northern states here the last couple of years. So supply demand, however, for the most part, real estate prices have been taking a hit, of course, with rates going up and the fear of recession. A lot of people are staying in their homes and the activity's declined. A lot of realtors looking for different professions. This is generally cyclical. We've seen this in the past. Now, when you look at the commercial real estate market, it's been okay, but it's about to get a little rough as well. And we're heading into a recession. How deep we'll see when you see the titans. You see these large tech companies, your Metas, your Googles, et cetera, not only laying off tens of thousands of folks, and that's probably just beginning. A lot of these rehires post-COVID and expansionary dreams. Also real estate, right? So if you're familiar with commercial real estate, when you lease out real estate, because these companies don't all own where they are, when you lease out real estate, if you want to get out of your lease early, you have to sublease it. And there are costs to doing that, and these companies are going to pay that upfront cost to rid themselves of the ongoing monthly stranglehold of a lease because they see what's coming. In a recessionary environment, you start to see this, and again, they start to move ahead of the time, so you know what's coming. Now, how deep, we don't know. Some of the titans, we won't mention here, financial industry are talking about a pretty deep recession, but again, we don't know till it hits. We called recession, back last June. We've had some rolling recessions. GDP has gotten off the mat a little here recently, but make no mistake, that's what's happening. And, here's the deal. Is it really a big surprise? The Fed, they've said their mandate is to crush demand. Now, that's a nice way of saying they must crush the consumer. It must be impossible for you to move. You can't get credit at decent rates, and you're probably not going to have a job, talking, generally speaking. That's what they need to see in English, okay? So that's the cold, hard, unpretty truth of it that you need to see. Now, on a human level, that's pretty awful, and you may see this in just everyday life around you. So certainly any folks that you can help out during this holiday season, certainly you want to do that. But that's what you're going to have to see. Now, on the retail end, we don't usually get into the granularity of individual stocks, but two behemoths, right? Your Target and your Walmart, two different earnings seasons, right? Target totally struck out, missed the pitch. They weren't even up at the plate. They miscalibrated. And Walmart which came in pretty good. Now, on the business end, obviously Walmart's helped by usually they just deal with a lower end consumer and their prices are attractive, so even higher income folks now may be shopping there. But then also structurally with inventory, they've done a better job apparently as well, in monitoring and managing, the changing landscape. So with that being said, from a market standpoint, we remain neutral, although we've increased some risk assets with the recent uptrend. But understand that it's an uptrend within an overall bear market. And until we're out of those woods, again, we have to prepare for that. Again, declining dollar and interest rates have helped in the interim. That's a short-term downtrend to what they call, support levels and an overall uptrend. Now, let's get to oil, right? Oil's dropped below $100 a barrel pretty nicely. The supply-demand metrics out there, you've seen, again, that's usually foreshadowing of a recession. However, again, energy and energy companies are still in a longer-term uptrend, and you would expect that to continue based upon, again, supply, demand, and macro, elements out there. But that decline is something to watch in a sense of that generally happens pre-recession. So again, keep your mind on that as well. Now, like we said before, earnings haven't been as bad as everyone portended, so we have had an upswing. The market may be trying to find a bottom, but we won't be convinced until it pierces an important technical level, which we won't get too granular, because I know a lot of you folks don't like all the charts and such. So just to give it to you the way you like it, we need to see a piercing, though, of some significant upward headwinds before we can call a bottom in. But we're not bullish or bearish in the short term right now, so you're seeing that play out in your strategies. Overall, bear market. I think I made that clear enough. We'll see the Fed. We're looking at 50 basis points in December after we called the last two 75s. While many thought 50, we think 50 this time. You've seen some squeaks out there. Now, until Uncle Jerry gets out there to the podium and that's released, we don't know. But because of the mix of retail data, we think it's possible, although 75 would be a hard hit because, again, when you have the algorithmic expectations, which have been 75 recently, that's why they responded well, especially in the last one. If they're expecting 50, and that's what the computers are, basically programmed to expect, and it doesn't happen, that's why we have to be eternally vigilant. So listen, it's Thanksgiving week. On last note, again, this is unofficial, but it was on Fox Business that they said the average retirement account's down 23% year to date. They didn't give details or granularity, so I'm just quoting them for compliance. A lot of our clients certainly have fared well relative, to the markets in general. I'll just say that. So again, family, friends, your health, give thanks to that. Of course, your wealth is, right up there as well. So we never take that for granted as we will continue to fight on for all you USC fans out there and be eternally vigilant. Till next time, Jonathan Camarda. Again, happy Thanksgiving and God bless you all.